Mike Tedeschi at Perspective Wealth Planning with this week's market breakdown video. We're going to dive in here and take a look at the four major U.S. indexes. We're also going to take a look at the U.S. dollar, which is making that break potentially above that resistance zone that we've talked about for quite some time. And we'll also jump in and take a look at the commodities and some breadth readings in on the Nasdaq. We saw what could potentially have been some capitulatory action on Monday, and so we are certainly going to jump in and take a look at some of the breadth readings there. Now, when we look at the S&P 500, we've talked about the importance on that 4,200 level, which were those lows from back in September. And you can see Monday we did dip briefly below that, but then had an extremely strong rally. Now, usually I don't put the 200-day moving average in on my chart, but you can see that it's right here. That's that purple moving average. And the reason why we're going to talk about it here today is a lot of people are watching this area. We broke underneath of it, but we held the main technical price action zone, which is a good thing. But when we bounced back up, we have now rallied into the underside of the 200-day moving average, and that's a return over from yesterday after the Fed spoke. We are basically getting pinched here in between this support zone and the 200-day moving average, and the direction that this breaks is going to be very important for us. We really want to see the market back over that 4,500 level to get back over this resistance zone, but a move underneath of this zone would basically negate the uptrend that we have been so clearly in here over the last year and would not be good price action. Let's take a look at the other indexes. We're going to take a look in at the Nasdaq. The Nasdaq, same kinds of comments apply here. We held right at that important breakout zone from back in June at that 14,000 level. We broke below it, but we had that big, strong reversal. We're well below our 200-day moving average, as the Nasdaq has been a leader to the downside so far this year. We take a look in at the Dow, very similar chart once again. We have our long-term trading range above that 33,000 level you've heard me talk about. This one reversed right there on it, but again stuck underneath a 200-day moving average. And when we jump in and take a look at the Russell, we have this extreme failure of the long-term range that we spent the last year in. We have talked about this extensively. This was a breakout that was unable to hold. We fell back into the range, and we have said multiple times the worst thing that we could see from a price action standpoint is breaking below that, because then we go from a false breakout to a breakdown, and those are not pretty. So my biggest concern here is the action in on the Russell. We're underneath of that 2,000 level. We're clearly underneath of the support zone there. The last vestige that we have in the area we bounced was actually last year's low of the year. We fall below this 1,900 level. There really isn't anything until we get back towards that 1,700. And as we have continued to talk about, the Russell, those smaller cap companies are a good gauge of risk on, risk off behavior. And right now they are certainly saying risk off. Now, last but not least, we'll take a look at the New York Composite Index, which is everything that's on the New York Stock Exchange. This looks very similar to the Dow's chart, where we had a push in the beginning of the year, and then basically we've been trading inside of a range. It reversed exactly where it needed to as well, in on this 15,800 zone. Right? It's also trapped below its 200-day moving average. This is a very important one to watch as well, because of what we have seen. We have seen certain areas of the market acting a little bit better than others. We've seen rotation take place a lot over the last year. This would be a very clear sign, if we break underneath of it, that there is nothing and subsequently holding us up. That would be a broad-based breakdown, and that would not be what we want to watch. So we are right there on those very key levels, and so we're going to need to pay very close attention to what happens here over the next week or so, because a move below here would certainly change our stance and our thought process in on the market. Now, we have talked a ton about the U.S. dollar and the 97 level, and what do we have right here? We finally broke above those highs from November. We're pushing above 97 right now as we speak. Now, I told you that the range is actually 97 to 98 is that kind of resistance zone before we kind of get back up towards that 100. But this is a very clear trending market. This has been a higher highs and higher lows now since the middle of last year, and in kind of that upward channel. Holding over this 97 would be a big break for the U.S. dollar. And you can start actually looking at this as a potential cup and handle pattern with maybe that breakout, which does, kind of forecast the potential for those higher prices in the U.S. dollar, which would not be a good thing for commodities. Again, commodities are priced in U.S. dollars, so a stronger U.S. dollar is a headwind for those commodities. And we saw over the last couple of days, gold starting to turn right back around. We got right back up to that 1850 zone, and now here we are back at the 200-day moving average, just barely holding on to 1800. Silver had that move back to 25. We were looking for that push. You can see that's the 200-day moving average. That's where it failed. It's back below 23. That's not the price action that you want to see there out of those precious metals. You've got palladium had just an absolute explosive move, but look where it failed as well, right there in on that 200-day moving average. And we'll take a look at platinum. Same comments apply there. And then when we leave the precious metal space and we jump over and look at something like copper, it's still holding above its 200-day moving average. It's been a very, very boring market after the big push up since basically March of last year. It is flat. Nothing has changed in on that front, so we'll pay very close attention over there. So now let's jump over into the energy space. We take a look at nat gas. We've talked about this a lot, just extreme volatility inside of this space, and we back it up and look at it in on a monthly time frame, right? We had that potential breakout, and immediately it was reversed. We've held that support zone. I still say that we're trapped between that 350 and that 480 zone in on nat gas. We come and take a look now at gasoline. Gasoline is pushing higher. One of the areas of this market that's still acting well is energy. So we see that gasoline is breaking to the upside, and let's take a look in at our oil. Oil is now at 88, so it is clearly broken above that 85 and continues to push higher. We know that our next kind of resistance zone on this long-term chart comes up around that 100 zone. This has been one of the only bright spots in the market so far this year. Energy and energy companies have done well, and they're leading the market so far in terms of performance year to date. So even though we have a strong dollar, that hasn't seemed to bother the energy space. And as I said before, our next kind of target up here, the hold over that 85, does come up around that $100 mark. Now, as we know, we go over breadth readings a lot across the board because it is very important for us to take a look at a broad-based analysis of the individual names underneath of the surface, because it gives us a better idea of what's going on than just taking a look solely at the indexes themselves. Now, the Nasdaq Composite has more than 30% of the stocks have closed at their 52-week low. And when we go back over the last 25 years and take a look at the times that this has occurred, they have occurred very close to a bottom typically, but there still can be some pain left in here. So let's go back to 2008, right? We can see for 2008, the next 6 months saw a negative 16% return. But then we started to get towards that bottom, and if you actually look a year later, the market was positive 13% of the time. This happened in 1998 before we had that blow-off, all right, into the dot-com setup. It happened in 2016, right before the election, where we saw that nice run since then. It happened again in 2018. Towards the bottom, and it happened again in 2020 towards the bottom, and here it is happening once again, right? So the concern when you take a look at this data set is not a year out. If you look at this a year later, the market is positive 100% of the time where this has occurred in the past. So that's a pretty solid sign for us. 6 months later, it was still very positive as well, with positive 82% of the time. Over the next couple of weeks, it was a little bit more difficult, and the areas where it didn't work out well lasted for pain for quite some time with some pretty decent sized down draws. So the concern, of course, is that where we're at right here is the beginning portion of a stronger sell-off. However, when we do look at it from this data set lens, it does seem to be a pretty good positive for us 6 months to a year later. Just another way of visualizing that same data, this is what this looked like where we had the 18th highest reading of stocks near their lows on the Nasdaq in the last 25 years. So you can see the only times that this got more extreme than that was in 1998, back in 2008, 2009, and 16, 19, and then of course the sell-off in 2020. So you can see a couple of these continued to push a little past this 30%, whereas back in 1998 that marked that pretty quick reversal. So we're at, again, a very key level. And when we look at all of the indexes themselves, and we look at the way in which this market is structured at this moment, we're at a very, very important zone. We're underneath the 200-day moving average for the first time in quite some time, but we're holding on to those major support levels in everything except the Russell. The New York Composite Index right there, the broad-based look at pretty much the entire market here is still holding on. So we really need to see these levels hold, and the price action that we see here over the next week or so is going to be extremely important. So as always, we're going to keep you guys apprised of what's going on. If you have any questions, you want to talk anything about the overall markets, please feel free to reach out to me. You can reach me at mtedeschi at Perspective Wealth Planning. I look forward to talking to you guys soon. Stay safe out there. Take care.